Welcome back to another episode of Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving into a topic that's been frustrating traders for years: trading contests. At first glance, trading contests seem like a great way to showcase skills, compete against other traders, and win exciting prizes. But here's the problem: these contests don't always reward the best traders, they reward the biggest risk takers. If you've ever participated in a trading contest, you've probably noticed that the winners often post insane returns, sometimes over 1,000% in just a few days. But in real world trading, that kind of performance is almost unheard of. So, what's really going on? Are these contests fair? Do they measure trading skill? Or are they simply rewarding reckless gambling? Today, we're going to break it all down: why trading contests favor risk over skill, the role of luck, and how you can compete smartly without blowing up your account. Let's get started. Music fades out. How trading contests are structured. To understand why high-risk strategies dominate these competitions, let's first break down how trading contests actually work. Most contests have the following rules. Fixed time frame. The contest lasts anywhere from a few days to a few weeks. The goal is to generate the highest possible returns within that short window. Profit-based ranking. The winners are ranked based on percentage returns, meaning the trader with the highest gains wins, regardless of the risks they took to get there. If a trader blows up their account, they simply restart and try again in the next contest. Demo versus real accounts. Some contests use demo accounts, removing the fear of losing real money. This makes it even easier for traders to take wild risks without thinking twice. Unlimited leverage. Many contests allow traders to use maximum leverage, enabling them to take enormous positions relative to their account size. At first glance, this structure makes sense. It's meant to create competition and excitement. But in reality, it incentivizes risky behavior over actual trading skill. Why trading contests reward risk over skill? Now, let's get into the real issue. Why do these contests favor reckless risk-taking over smart, skill-based trading? 1. Time constraints encourage aggressive trading. Let's say you're competing in a one-week trading contest. If you're a disciplined trader, you might follow proper risk management and generate a solid 10% return. Sounds good, right? Well, now imagine another trader who takes massive, leveraged bets, hoping for a huge payoff. If their trade works out, they might end the week with a 200% return. Guess who wins? The trader who threw risk management out the window. 2. The all or nothing mindset. Since trading contests only reward the top few traders, there's zero incentive to play it safe. Many participants think, if I go all in and win, I'll get a huge reward. If I lose, I'll just try again in the next contest. This is not how real traders succeed. Skilled traders focus on capital preservation, consistency, and risk control, not gambling on a single big win. 3. No real consequences for losing. In real trading, losing too much means you're out of the game. But in a contest, if you blow up your account, who cares? You can just join another contest. If you take a bad trade, there's no long-term financial damage. It's just virtual money. This creates a casino mentality, where risking everything feels justified because there's no real penalty for failure. 4. Luck plays a bigger role in short-term trading. Short-term trading contests are often more about luck than skill. Why? Market fluctuations can randomly favor one trader over another. A single big trade can skyrocket a trader to the top of the rankings. The winner might not be able to repeat their success in real markets. In real-world trading, professional traders aim for steady, sustainable gains over months and years. But in a one-week contest, luck often determines the winner. Case study: Financial Times stock picking contest. A great real-world example is the Financial Times stock picking competition. Participants pick stocks they believe will generate the highest returns within a set time frame. The winners? They usually pick highly volatile, speculative stocks that either skyrocket or crash. Professional traders and hedge funds rarely win because their risk-adjusted strategies don't generate the insane short-term returns needed to win. This proves that short-term contests don't reward careful, well-researched trading. They reward risky, all-in bets. How to compete smartly without reckless gambling. If you want to join trading contests but avoid reckless gambling, here's how to compete smartly. 1. Optimize your risk reward ratio. Instead of going all in, look for high probability trades with a strong risk reward setup. Aim for trades where you can win more than you lose over multiple trades. 2. Use controlled leverage. Instead of maxing out your leverage, use it strategically, only for setups that justify the risk. 3. Trade volatile assets but with caution. Markets like Forex, crypto, and small cap stocks offer big moves, but manage your risk carefully. 4. Scale into positions gradually. Rather than making one big bet, enter positions in stages to reduce downside risk. 5. Choose contests that reward skill, not just risk taking. Some trading competitions focus on risk-adjusted returns rather than just total profit percentage. Look for those contests, as they favor smart trading over reckless bets. If you're looking for fairer trading contests, check out crystalballmarkets.com. They offer competitions where traders are ranked based on consistency, not just crazy percentage returns. Final thoughts. Trading contests are exciting, but let's be real. They often reward the riskiest traders, not the smartest ones. The short time frames, profit-based rankings, and lack of real-world consequences create an environment where reckless risk-taking wins. But if you want to compete without gambling your way to the top, focus on smart risk management, volatile but well-planned trades, scaling into positions instead of going all in. And remember, real trading success isn't about taking the biggest risks. It's about consistency, discipline, and managing risk like a pro. That's it for today's episode. If you found this discussion helpful, don't forget to subscribe and share this podcast with fellow traders. And if you're looking for a trading contest that actually rewards skill, check out crystalballmarkets.com. Until next time, trade smart, stay disciplined, and never stop learning.